Welcome to Financial Education. In this video, I'm going to explain how information from option quote on an individual stock is used to make simple option investment decision. Using options on Apple stock, the simple numeric examples will make it very easy for a beginner to interpret different scenarios that may happen. Although the option quote information may seem old, the interpretation can be applied to any recent information. More specifically, the underlying reasoning would stay the same. Let's define option. An option is a contract which gives the buyer the right, but not the obligation, to buy or sell a stock or any other underlying securities for a specified price on or before a specific date. There are two types of options: a call, giving the right to buy the security, and a put, giving the right to sell the security. One important point to remember is that one option relates to 100 stocks. In other words, if you buy one option, you are buying the price movement of 100 underlying stocks. Now, how to decide whether to buy a call or put option? The rule of thumb is when you believe the underlying stock price would go up, you buy call option. When you believe the underlying stock price would go down, you buy put option. Let's take an option example. Look at the Apple options. Suppose you buy an August expiration call option with exercise price of $355. Now, first question. If the stock price in August is $367, will you exercise your call option? What are the profit and rate of return on your positions? Yes, the option will be exercised. The rule is, as long as the stock price at expiration exceeds the exercise price, it makes sense to exercise the call. Here's the calculation. Gross profit would be the current market price 367 minus the exercise price, which is 355, times 100, because one option equals 100 shares. That gives you $1,200. What is the cost of buying? The premium that you paid for this option is 13.7, comes from the table, times 100 equal $1,370. So the net profit is $1,200 minus $1,370, which is a loss of $170. So the rate of return is negative 170 divided by 1,370, which is your investment, gives you 12.41% loss. So this investment yields a negative return. Question number 2. What if you had bought the August call with exercise price of $360? The option will still be exercised because the stock price of $367 is above the exercise price of $360. So the gross profit is $367 minus $360 times 100, that gives you $700. Cost of buying was 11.15, which was your premium, times 100 stock equals 1115. Net profit is 700 minus 1115. That gives you a loss of $415. So the rate of return would be negative 415 divided by 1115. That gives you a 37.22% loss. Again, this investment is a loss investment. Question 3. What if you have bought an August put option with exercise price of $355? Now, as you remember, put option is when you think stock price is going to go down. If stock price goes up, you don't make any money. In this example, the exercise price is $355, but the stock price went up to $367. So, a put with an exercise price of $355 would expire worthless for any stock price equal to or greater than $355. An investment in such a put would have a rate of return over the holding period of negative 100%, meaning that the investor will lose all of his premiums that he paid. I hope you now understand the basic concepts of option investment. Thanks for watching.